Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of January 5th, 2025. And in this week's episode, we are going to talk about secondary signals. When it comes to signals, there are so many signals out there that you can pick from, and all different types of charting platforms, brokerage platforms. There's just signal after signal after signal, and they can be incredibly confusing. And so in this week's episode, I'm going to take a look at a couple of the signals that I like to use as a secondary guide to my trade. And it's important to remember that there is no such thing as a forward signal. Basically, every signal, every chart pattern, every indicator that you can put on there is all backwards looking. And so it's very, very important to remember, because if it was forward looking, then it would be very predictive of what's going to happen, and everybody would use it, and it probably wouldn't be worth much. So in this week's episode, I'm going to take a look at some of the secondary signals that I use, as we talked a lot about my primary signals of volatility and liquidity in past episodes. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. You also find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find us there, let us know and we will get it there. Well, let's hop to this week's content. And this week's content is kind of secondary signals. As 2025 gets off to a start here this week, is the first trading week of the year, I started kind of doing a little bit of homework about what plays I might want to be looking at, what trades I might want to make in the upcoming week. And as I was kind of looking through them, I realized, there are some secondary indicators that I typically use day to day when I'm kind of screening for plays to touch on. And I thought, this might be a great opportunity to kind of run through some of those. And so that's what we're going to talk about in this week's episode, is a couple of the signals and indicators that I use secondarily to what really lets me know where I'm going to play these trades. So let's start out and look at basically the prioritization of the different signals I use when kind of scoping out the plays that I'm going to take, when screening the market and stuff like that. And so I've listed 5 of the very primary signals and indicators that I use. The first 2 are what you hear me talk about all the time: volatility and liquidity. These are really my gatekeepers to knowing if I'm going to even consider a particular underlying as a trade. This is where I am asking the question, is there a play to make? And once I kind of decide if, volatility is high enough, and liquidity is good enough, then I start looking at the secondary signals. If we don't pass the volatility test and we don't pass the liquidity test, I never bother looking at the secondary signals. The secondary signals to me help guide me on what is the play. So, I sell a lot of premium. That's pretty much what I'm always doing when I approach these. That's where that elevated volatility comes from. But what's important is, once I know I want to sell premium, the question is, what premium do I want to sell? Where do I want to sell it? Do I think that we might be going up, down, sideways, that type of stuff? And that's where these 3 secondary signals really come from. The first one listing isn't necessarily an exact signal per se. It's called basically price action. And this is something that I'm working on getting better at. It's something that I don't think you'll ever be perfect at. It's a very subjective kind of art. At least that's what I think. And the more that you practice it, the better you become, and the cleaner you can see things. We talk about it a lot, price action with Viper on the show, and I equate it to kind of looking at clouds. You can look up at clouds and different people can see different things, but if you look at enough clouds, you'll start to kind of see patterns and stuff like that mean something to you. But that doesn't necessarily mean that all the traders will see the same things. So price action really isn't so much of a actual black and white signal that you can add to your chart, but it is one of the things that I do consider, and we'll talk about that as we kind of move on. The next signals is number 4, moving averages. This is really kind of 3 signals in one. In all of my charts, I always have 3 moving averages going: 21-day moving average, a 50-day moving average, and a 200-day moving average. This just really helps me see, where is this respect to the average over time, looking backwards. And the 21 days is kind of a sharper curve. It adjusts more rapidly to changes because it's only calculating the average over the past 21 days. 50-day is kind of my mid-range. So it's basically calculating the average price over the past 50 trading days. And it is a little bit slower than the 21-day. And then the really slow one is a 200 moving day average, which is the average price over the past 200 days. And then I always put that on with my candlestick chart, and I'll show you some examples of that. And then the last one that I look at is an oscillating signal, which basically means it goes between a minimum value and a maximum value and kind of floats between those two. And it's called RSI, which stands for Relative Strength Index. And we'll talk about that. I typically use just the default out of my brokerage account, which is pretty much the default at any charting platform that you want to take on. And so these three things combined help me decide what direction I'm going to sell. Am I going to sell the bottom side? Am I going to sell the top side? Am I going to sell both? Where am I going to get my premium from? So let's go ahead and take a look at the very first one, moving averages. Now, this is a snapshot of Delta. It just happened to be an underlying that I threw up there to see, to show you what my charts look like in Thinkorswim. You can replicate this in any sort of charting platform or brokerage account that you have. I've got three lines here. I got the green line, which is the 21-day moving average. The yellow line is the 50-day moving average. And the red line is the 200-day moving average. And the rest of these are daily candlesticks. And what I want to call out here is a lot of times the moving averages, I kind of think of them like price action on training wheels. A lot of the way that the price reacts against these moving averages tend to be also price action levels. And so while it might take a while to get used to looking at particular price action, and price action is much more relevant to the clear and here and now, the moving average is a little bit backwards looking, but a lot of times those same levels that price is going to react against also happen to line up with price action levels. So it's not really a replacement for price action analysis, but you'll see that a lot of times it kind of validates price action. And what you typically see along these moving averages is some sort of reaction by the price. And so these levels tend to be resistance or support, depending on which side of the averages you are. And so if you take a look at Delta, I kind of highlighted to the left here, 3 yellow arrows, where basically Delta was in a downward trend. And you can see every time the price kind of rallied up to these moving averages, you kind of got a rejection off of there. Now, it's not as crisp and clean as some price action can be, because you'll see, you don't necessarily touch the moving average. You're kind of approaching them and kind of rejecting down. And then the same thing happens again on the way up. I didn't mark them with lines, but you can see off this 21-day moving average, the price kind of comes down to the 21-day and reacts off of it. Comes down, reacts off of it. Comes down, reacts off of it. So it's not a super, concrete way that it's going, but it's a secondary signal to me to say this is likely where we're kind of heading with certain price. And you can see here, we started switching direction and we broke the 21-day moving average up here on this yellow arrow that I called out. Then it touched the 50-day moving average, which offered a little bit of support. And then it kind of came off that 21 again as resistance. And then it broke through this 50-day moving average here most recently. And so in all likelihood, probably your next stop is going to be down here around the 200-day moving average, which also happens to coincide to this kind of previous high level back here, which is where price action would tell you there will be another reaction to price around there. And so it all kind of correlates and it's all kind of related. But this is typically when I'm looking at this. So if I was looking at Delta here, I would say, you know what, it's very likely that Delta will be in a downward trend from here, as we just recently broke the 21-day. 21-day was resistance, and then the 50-day failed. So this is kind of a little bit of a signal to me that we are likely heading more into a bearish move here on Delta. And the next signal I want to talk about is that RSI indicator that I mentioned earlier. It stands for Relative Strength Index. And I really like this indicator. It's kind of a two-step indicator. It's sort of related to averages. Its default setting is about a 14-day look back. And so what you'll see here is the RSI has the number 14 in this formula. That is the look back period. You can change that, although typically 14 days is considered the standard when you're using an RSI indicator. Then you'll see 2 yellow lines. You'll see a line here at 70 and a line here at 30. So this oscillator basically goes between 0 and 100. And what it stands for is how overbought or how oversold is the particular underlying. And it's calculated in 2 steps, and you don't really need to quite understand exactly all the math behind this, but know that it's basically taking the average gain over the average loss over the past 14 days and kind of adding them up. And so what you'll typically tend to see as you approach the 70 and breach the 70, you become very, very overbought. And then a lot of times the price and the price action and the selling pressure will kind of ramp up. Selling will increase, price will kind of come down. And as price comes down, then this indicator also comes down. And when you typically kind of dip down here at the bottom where you're oversold, it basically means, hey, there's too many people selling. We're really kind of approaching a bottom. And then you'll start getting this strength indicator swinging back to the upside. That's why they call it an oscillating signal. It basically goes up and down, up and down. And so anytime you're kind of trending in the middle here, you're basically kind of at a fair price or a fair overbought, not overbought and not oversold. Now, this isn't like super reliable to know that when you are over bought, it doesn't really mean that you're immediately going to reverse the other direction. A lot of times when you get into an overbought condition, it will continue to be overbought and price will just continue to rise and rise and rise and rise. So a lot of times if you are seeing an overbought in a bullish condition, a lot of times that will continue to be overbought. And if you just likewise, if you see an oversold condition and you're in a bearish trend, it is almost like it will continue. So the next thing I want to do is kind of take you into 2 tickers that kind of surface through my screening that I'm considering putting a play on this week, and show you how those signals kind of factored into what type of play am I looking at making here. So the first one I'm going to pull up here is MBLY. MBLY, I think they have something to do with autonomous driving. I'm not actually 100% certain, but to be honest, I never really pay much attention to that when I'm looking for these plays, as a lot of it is based on volatility. And so what caught my eye here with MBLY is the elevated volatility. And in my screener, this was sitting around 90% historical volatility of elevated IV, and you can kind of see that here in this green chart. Now, the one thing I don't really like about this, which is not amazing, is you in this heightened state of elevated volatility. So I like to play volatility contraction, but you see how much this price has moved here, but the whole time volatility remained high. And that doesn't bode well for my normal play of looking for volatility contraction. I like to go with the overstated volatility because it collects more premium, but I also like to see ramp downs looking for volatility contraction, where this one is kind of staying elevated. Nonetheless, it did pass my volatility screening test and it did pass my liquidity test. So that basically means it's for me to look into the secondary signals and decide, what do I think about where I want to trade this? So I'm going to talk you through what kind of goes through my head as I'm looking at this chart. So if we look up here, you see my moving averages, and you can see that, not so long ago, back over the summertime, we were probably in a bearish trend where your 21-day, your 50-day, and even your 200-day were acting as resistance, kind of pushing this stock down. And then right in here around October timing, end of October, beginning of November, we started to see a reversal where price is now trending above those moving averages. And then again, we are seeing support off of the 21-day, support off of the 50-day. And right now we're kind of battling right at the 200-day. In fact, the most recent candle closed above the 200-day moving average. So this is a very positive sign for upward momentum and upward pressure on the stock. Now, if we put that in a combination of where is it in the RSI indicators, so the RSI indicator is this chart on the very, very bottom. You can see that during this bearish sell-off, here's what I'm talking about. We remained oversold for quite some time, and we continued to go down and go down. But right here is where we started to creep back up above that. And this is a good indication that we are probably trending to a price reversal. Sure enough, shortly after that, so at the beginning of September, we started coming out of the oversold condition, and the RSI was kind of building and building and building momentum. And now all of a sudden you start seeing the price come as a reversal, and we're moving into a bullish trend. So what I like here is we are at the very top end here of the RSI. I won't say the top end, you're basically 70 percentile. Like I said, it goes all the way up to 100, but a lot of times you'll stay between 70 and 30. And so we're just now starting to kind of come above that. Now, this is one of the areas that when I am looking to sell calls, I tend to not sell calls unless we're pushing in an overbought situation. And we're getting really close to that. The reason is because I don't really want to get challenged on the call side when I sell premium. So I like to see the RSI kind of indicating that, hey, we might be approaching an over bought condition. Now, because this is kind of creeping above the 200-day, it's very possible that we're going higher. The options chain actually indicates as much with quite a bit of risk to the upside. Now, what would I play on this trade? A strangle is what I'm looking at. And the reason I'm looking at a strangle is because of the elevated volatility, so I can get pretty low and I can get pretty high. Additionally, on the high side, when I typically look at a 20 delta strangle, this one would be around the $30 mark is about the 20 delta. And this $30 mark is interesting to me because that's right up here where we had this most recent kind of high that we started falling off to. And so I would speculate that we're going to start to see resistance on a price action level somewhere as we approach this previous 52-week high, which is at 34. So 30 is a little bit below that, but I'm pretty comfortable kind of going into that. Now on the bottom side, the 20 delta is somewhere around a $17 strike. So I would be looking at a strangle between 17 and 30 here on MobileEye. So let's just take a real quick look at the profit and loss chart here of that $30 strike, 17 strike. So this is looking at February 7th of expiration. February 7th would be about 33 days out to expiration. It happens to be a weekly with a 97% volatility. And if we look at that profile here, this is what we're looking at. If we set the gray period to the 1 standard deviation at expiration, you can see that this trade, I went ahead and looked at 10 contracts, 10 contracts kind of fit the position sizing of about $3,000 that I was kind of looking for. And so you can see here that this is where we're currently trading. These two dotted lines are a 10% move up and a 10% move down. So the 30 strike is well outside the standard deviation move. Standard deviation is this gray area. That's what the volatility is indicating, can be the up and the downside. Of course, the downside is down here where I would be losing a little bit of money, but I'm usually okay getting assigned as we kind of come down there, and then going up to 30 and being assigned at 30, right, you're going to be in a very, very, very overbought condition. So the likelihood of a reversion to the mean, 33 days out, this is definitely a trade that I'm looking at taking this week on MobileEye. And the only real demerit with this trade was kind of that, doesn't look like there is a lot of volatility contraction that happens here, as we've kind of been in an elevated state of volatility since June. But that's just one of the aspects of how fast I can kind of get my money back is if you get contraction, you can get your return really fast. If you don't have contraction, time will still eat away at it. And you still will get it back. It just doesn't happen as fast. And so that's kind of the demerit that I'm looking at here when it comes to MobileEye. That's really the only hesitation to the trade. I really like the volatility. I really like where the price is. I really like where it is relative to the indicators that I use and where it is relative to price action. So it checks a lot of the boxes for me. And that's really the first one that I wanted to take a look at. The second example that I want to take you guys to is PINS. PINS is Pinterest, and I want to take a look at Pinterest because this one also hit my heightened volatility scanners, and those scanners, looking at that, then I moved to the secondary indicators, and so let's talk through the chart there as I see it with Pinterest. So if you pull it up again, you'll see one thing that jumps out here with the elevated volatility is see these cliffs. These cliffs are exactly what I like to see. Volatility contraction, volatility contraction. Now they're around earnings. So you can see these little bubbles here. Every time you get one of these bubbles, you get a drop, bubble, drop, bubble, drop. So what's probably going on right now with Pinterest is they are building to their next earnings release, and very likely there will be a volatility contraction off of that and the price drop. Pinterest is one of the stocks that I play multiple times week of earnings because it has a very, very strong historical trend of volatility contraction after earnings announcements. But let's take a look at the secondary indicators because we've passed my volatility screen and we've passed my liquidity screen. And so right now, Pinterest is kind of looking bearish. we flipped over here. We had a previous 52-week high around $45. We failed the 21-day moving average. We failed the 50-day moving average. We failed the 200-day moving average. And you can see all of these moving averages became resistance. Now, we did break through the 21 briefly, and we kind of been fighting back and forth between the 21 and the 50-day. But this 200-day has been kind of a holdout where we've rejected off of it 1, 2, 3 times. So what does this indicate to me? Also looking at the RSI, you can see here is our very overbought, here is our very oversold. And right now we're at 53, which is pretty much right down the middle. And so Pinterest here with this volatility contraction, with this resistance that we see, again, this is another strangle candidate for me. Kind of looking at about a 20 delta strike, going out same amount of days, about 33 days, that February 7th expiration weekly. That's going to be around the 35 mark on the high side and 28 on the low side. So why do I like those levels? Why am I not scared of those levels? This goes back to price action. So let's start with the low side, 28. That's what I've got right here. And you can see we've bounced off the 28 here. It has been historically a sign of support. So I am pretty confident that if we lose here and we go down, when we get to that 28, we'd be looking at another kind of either support or pause or something to that. And all I need it to do is buy me time and eat up time so I can get that time premium back. So I'm very, very comfortable to the low side. And honestly, if we breach below it and I get assigned early for some reason, I'm okay buying at 28 because that has been a relative low point of the past 52 weeks. 27 is the absolute low point of the past 52 weeks. So I'm okay on that side. Now, what about the high side? I said the strike is around 35. Well, where's 35 at? 35, it's not as amazing on the price action, but you can see we've got a level up here where we were rejected off of a 40 and kind of fell below. And 35 is definitely kind of close to this moving average here where we reject. So the chances are if we rally up to 35, we very likely could be stalling out and kind of coming back in. So it's not as great of an upside trade as the MBLY where I felt more comfortable. But I am okay with it because every time that Pinterest is kind of busted up real high to the high side, it doesn't tend to hang out up in the stratosphere for very long. It kind of comes lurching back down to earth. And so again, this trade is something that definitely would consider. If we want to go ahead and take a look at what does that look like on a P&L chart, can move over and take a quick look at the options. I went ahead and threw the Feb 7th, 35.28. I looked at 5 contracts. I probably could take that up one more to get close to that 3,000 position sizing here. So you can see it'll be collecting about $1.64 a contract. If we look at Feb now, you notice where the standard deviation and this expected move and this, it's not quite as spacious as the MBLY. So this is not as nice as MBLY, where MBLY had a lot of room in there, but this particular underlying does have a lot of volatility contraction. And so as volatility contracts, this standard deviation will really kind of shrink and kind of come in. And so I'm kind of okay that the standard deviation move really pushes out to the break evens on the high and low side. The price action kind of supports the lack of, not super concerned about the high side and the low side, but it is more probabilistic than MBLY that will kind of reach these, 30 break even strike up here at 36 or the 26.30 break even on the low side. So that brings us to the end of this week's episode. Kind of a quick episode, but I just really wanted to touch on those kind of secondary indicators where they're not anything that says, yes, here's a trade, take this trade, but more of one other criteria fall into place. It's more of kind of the fine tuning about, okay, what's the direction? Where are the strikes? How comfortable am I in the fact that this is elevated volatility? How comfortable am I where the strikes will kind of pull up and see? And so this certainly, these indicators could be used for swing trading. They could be used, whether or not to buy shares or sell shares, or know if, you're getting close to a drop-off point or things like that. So it's good to kind of experiment around here, and see what type of indicators you like, back test them, put them through paper trading, see what indicators you're comfortable with. I've tried a lot of different ones. I try not to use too many indicators because, like I mentioned at the very beginning, all indicators are backwards looking. So they're all basically historical type indicators. They don't really give you much indication about the exact right now moment, let alone the future moment. That's where I like the volatility selling, because probabilistically you will tend to get a reversion to the mean. That's why I like oscillating signals, because a lot of times you get this reversion to the mean. And these are just two signals. Check them out, see if they strike your fancy, or what you think of them. So good luck out there as we approach 2025. First full trading week in the year this week. So good luck out there. Have fun. And remember, think outside the block.